Are you one of the millions of people who have been burned by the stock market, watching in horror as your hard-earned savings seem to evaporate into thin air? You're not alone. In fact, a staggering 75% of individual investors consistently underperform the market, with some studies suggesting that the average investor earns returns that are a whopping 4% lower than the overall market average. This is a disturbing trend, and one that has puzzled researchers for years, with many wondering why it is that individual investors seem to consistently make the same mistakes over and over again. According to a study published in the Journal of Finance by researchers Brad Barber and Terence O'Dean of the University of California, Berkeley, this phenomenon can be attributed to a combination of factors, including overconfidence, emotional decision-making, and a lack of diversification. But here's the thing, the stock market, despite its ups and downs, has historically always trended upwards over the long term. In fact, a study by Jeremy Siegel, a professor of finance at the University of Pennsylvania's Wharton School, found that since 1802, the U.S. stock market has returned an average of around 7% per year, outpacing inflation and bond yields. This is a remarkable statistic, and one that has been confirmed by numerous other studies, including one by Robert Shiller, a professor of economics at Yale University, who found that the stock market has consistently provided higher returns than other assets, such as bonds or real estate, over the long term. So, why is it that individual investors seem to struggle to capture these returns, and what can be done to change this? The answer, it turns out, lies in our brains and the way that we process information. According to a study published in the journal Science by researchers Andrew Lo and Dmitry Repin of MIT, our brains are wired to respond to short-term market fluctuations rather than focusing on long-term trends. This can lead to a range of behavioral biases, including loss aversion, where we become overly focused on avoiding losses rather than seeking out gains. Now, you might be wondering, what does all of this have to do with you, and how can you use this information to start building wealth? The key, it turns out, is to take a step back and look at the big picture. Rather than trying to time the market, or pick individual winners and losers, it's often better to take a more diversified approach, spreading your investments across a range of different asset classes. This can help to reduce risk and increase the potential for long-term returns. And, as it turns out, this approach is supported by the science. A study by researchers at the University of Chicago found that diversified portfolios tend to outperform those that are more concentrated, and that this effect is particularly pronounced over the long term. This makes sense when you think about it, as diversification helps to reduce the impact of any one particular investment, allowing you to ride out market fluctuations and stay focused on your long-term goals. But, despite the wealth of evidence supporting the benefits of diversification, many investors still struggle to put this into practice. According to a study by researchers at the University of California, Los Angeles, this is often due to a range of cognitive biases, including confirmation bias, where we tend to seek out information that confirms our existing views rather than challenging them. This can lead to a kind of tunnel vision, where we become overly focused on a particular investment or strategy and fail to consider alternative perspectives. And, as we've seen, this can have disastrous consequences, as investors who are overly concentrated in a particular asset class or sector can be wiped out if that area experiences a downturn. So, how can you avoid this trap and start building a more diversified portfolio? One approach is to use a technique called dollar-cost averaging, where you invest a fixed amount of money at regular intervals, regardless of the market's performance. This can help to reduce the impact of market volatility and increase the potential for long-term returns. As we've seen, the stock market has historically always trended upwards over the long term, and by taking a more diversified approach, you can increase your chances of capturing these returns. But it's not just about the investments themselves, it's also about the way that you think about money and the role that it plays in your life. According to a study by researchers at the University of Michigan, our attitudes towards money are often shaped by our early experiences and can have a profound impact on our financial decisions later in life. For example, if you grew up in a household where money was tight, you may be more likely to be risk-averse and to prioritize saving over investing. On the other hand, if you grew up in a household where money was plentiful, you may be more likely to be reckless and to take on too much debt. By understanding these underlying attitudes and how they shape your financial decisions, you can start to make more informed choices and to build a more secure financial future. And, as we've seen, this is a critical step, as the way that you think about money can have a profound impact on your financial outcomes. By taking a more nuanced approach and considering the psychological and emotional factors that drive your financial decisions, you can start to build a more sustainable wealth-building strategy. One approach is to use a technique called mindfulness, where you pay attention to your thoughts and feelings and try to cultivate a more aware and intentional approach to money. This can involve setting clear financial goals and tracking your progress over time, as well as seeking out support and guidance from financial professionals. By taking a more mindful approach, you can start to make more informed decisions and to build a more secure financial future. But what does this actually look like in practice, and how can you start to implement these strategies in your own life? Let's take a closer look at some specific examples and explore how you can start to build wealth and achieve your long-term financial goals. By understanding the psychological and emotional factors that drive your financial decisions, and by taking a more nuanced and informed approach to money, which is exactly what we'll be discussing in the second half of this video, as we delve deeper into the world of behavioral finance and explore the ways in which you can use this knowledge to start building wealth and achieving your financial goals. And that's where we'll pick up, as we explore the ways in which you can use the power of behavioral finance to transform your financial life and start building the wealth and security that you deserve. But for now, let's just say that it all starts with a deep understanding of the psychological and emotional factors that drive your financial decisions, and a willingness to challenge your own assumptions and to think differently about money, which is a topic that we'll be exploring in much more detail as we continue to examine the ways in which you can use the power of behavioral finance to build wealth and achieve your long-term financial goals. And that's where we'll pick up, as we explore the ways in which you can use this knowledge to start building the wealth and security that you deserve. But for now, let's just say that it's all about understanding the psychological and emotional factors that drive your financial decisions, and using that knowledge to make more informed choices and to build a more sustainable wealth-building strategy, which is exactly what we'll be discussing in the second half of this video, as we delve deeper into the world of behavioral finance and explore the ways in which you can use this knowledge to start building wealth and achieving your financial goals. And that's where we'll pick up, as we continue to explore the ways in which you can use the power of behavioral finance to transform your financial life and start building the wealth and security that you deserve. Now that we've covered the science behind why the stock market tends to go up over time, let's dive into some more fascinating research that supports this concept. A study by Professor Robert Shiller, a renowned economist, found that the stock market has consistently outperformed other investments over the long term, with an average annual return of around 10%. This is because, as we discussed earlier, companies are constantly innovating and growing, which in turn drives up their stock prices. But what's even more interesting is that Shiller's research also showed that this growth is not just limited to the U.S. market, but is a global phenomenon, with stock markets in developed countries around the world experiencing similar growth patterns. Another study by Professor Jeremy Siegel, a finance expert at the University of Pennsylvania, found that over the past century, stocks have consistently outperformed bonds, with an average annual return of around 7% compared to just 2% for bonds. This is because, as Siegel notes, stocks offer a claim on the future earnings of companies, which can be incredibly powerful over the long term. But what's important to remember is that this growth is not always linear, and there will be ups and downs along the way. However, by understanding the underlying science and trends, you can make informed decisions that will help you profit from the stock market's upward trajectory. So, how can you apply this knowledge to your own finances and start profiting from the stock market? First, it's essential to have a long-term perspective. This means avoiding the temptation to try to time the market or make quick profits, and instead focusing on steady, consistent growth over time. For example, let's say you invested $1,000 in the S&P 500 index 10 years ago. Today, that investment would be worth around $2,500, even with all the ups and downs of the market. That's the power of long-term investing. Second, it's crucial to diversify your portfolio. This means spreading your investments across different asset classes, such as stocks, bonds, and real estate, to minimize risk and maximize returns. For instance, You could invest in a mix of low-cost index funds, which track the performance of the overall market, and individual stocks, which offer the potential for higher returns. By diversifying, you can reduce your exposure to any one particular investment and increase your chances of success. Third, you need to be disciplined and patient. This means avoiding the urge to buy and sell based on emotions, and instead sticking to your long-term plan. For example, during the 2008 financial crisis, many investors panicked and sold their stocks, only to miss out on the subsequent recovery. By contrast, those who stayed the course and continued to invest regularly were able to take advantage of the market's upward trend and reap significant rewards. Finally, it's essential to educate yourself and stay informed. This means reading books, articles, and online resources, such as financial news websites and blogs, to stay up to date on the latest developments and trends in the market. For instance, you could start by reading The Little Book of Common Sense Investing by John Bogle, which offers a comprehensive guide to investing in the stock market. By continuously learning and expanding your knowledge, you can make more informed decisions and increase your chances of success. To illustrate this concept, let's consider a real-life example. Imagine you're a young professional who starts investing $500 per month in a low-cost index fund. Over the course of 10 years, you contribute a total of $60,000, but the value of your investment grows to over $100,000, thanks to the power of compounding and the stock market's upward trend. That's a return of over 60%, simply by investing consistently and patiently over the long term. In conclusion, the stock market's tendency to go up over time is not just a matter of chance, but rather the result of underlying scientific principles and trends. By understanding these principles and applying them to your own finances, you can make informed decisions that will help you profit from the market's upward trajectory. Remember, investing in the stock market is a long-term game, and it requires discipline, patience, and education. But with the right approach, you can achieve significant returns and secure your financial future. If this helped you think about money differently, subscribe. I post new finance insights every single day. And if you want to go even deeper, check the link in the description for The Little Book of Common Sense Investing by Bogle. It changed how millions of people think and act.